know, we have seen a rise in equity markets. Gold prices as well have seen quite a rally. So we'll be talking to you about whether now is the time to sort of maybe rebalance your portfolio, maybe consider trimming the equity exposure in your portfolio a bit. And for all of you who have gold, we always say, right, you should have 5 to 7% of investable gold in your portfolio, not of course consumable jewelry gold, but investable gold. So should you consider booking some profits in that investable gold? All of that will be discussed today on the Money Show. And for that, I have with me Dilshad Bilmoria of Dilzar Consultants. Dilshad, many thanks for joining us today on the Money Show. Appreciate you giving us your time, and hope you, and your team are doing safe amidst this entire pandemic. So to start with, Dilshad, I just want to get in your rough opinion on how you see the markets move. Because I mean, let's face it, for mutual fund holders, it's been red across the screen, and especially if you've invested in the last 3-4 years in mutual funds, you're going to be pretty disappointed with what your mutual fund portfolio has churned out. Now everybody wants to know what's next, right? What's the market going to do next? So what is your opinion roughly on the way things are?
Right. So as you rightly said, I think the last 3 years has been quite bad, both on the equity and debt side in the markets. Equity for reasons being that economic growth and corporate earning results have not picked up. So that's a major reason why the equity side of the market has not done well. And on the corporate debt side, as we see, there are many defaults and by credit rating firms. So that has contributed actually to the fall in a couple of debt mutual funds. So having said that, both the debt and equity category of mutual funds has actually fallen, and people are looking at gold in the recent past. So gold actually is something that we've always said to allocate in one's portfolio to the extent of between 5 to 10% of one's portfolio.
Yeah, that's ideally what the percentage should be, 5 to 10% of the portfolio. We'll talk a bit more about gold. But Dilshad, I also want to ask you, when we look at our portfolio in general, we want a certain percentage to be equities, we want a certain percentage to be debt. And now we've seen a nice bounce come by in the equity markets, right, in the last 3 to 4 odd months, or since that big fall that we saw in March. Do you think that investors should say that, okay, look, the market has rallied a lot, let me take some money off, equities? Or do you think that now is the time when people should consider, reviewing or rebalancing their portfolio in any manner?
Right. So every rise in equities or in the equity market need not necessarily lead to a sell-off in one's portfolio. There are various costs associated on sale. So one must obviously look at those costs. I would say the reasons one must look at, selling, either stocks or mutual funds as part of their portfolio should only be to realign the portfolio and to, readjust earlier concentrated too high, or to ensure that if certain funds were not doing well, and to ensure that it moves in tandem with one. Or to use tax harvesting as an investment option when the markets are high by selling some of the equities. So I think the rationale and the reasoning should be very clear in consultation with the financial advisor as to why one wants to sell their equity. So it should not be a simple sell-off just when the markets are up.
Yeah, that's very important to take note of. Just because the markets are up, that does not mean you start selling bits of your, portfolio. You need to know, I mean, there should be a purpose, right? That why you will be selling, a part of your portfolio, or why you want to, reduce your exposure to equities. It's also important to understand that, for long-term retail investors, you are in all probability investing for a certain goal. And that's the reason why you use equity mutual funds as a tool to achieve those financial goals. So, Dilshad, how should one essentially allocate money across different asset classes? And I know your answer will be completely different for maybe someone who's young, just starting off their career, and it'll be completely different for somebody who's, maybe stepping closer towards retirement, or probably someone who's already retired.
Right, absolutely. So typically, the asset allocation, like like you rightly said, Mobina, would depend on the age profile, the risk profile of the investor, the time horizon to the goal, investment objective, and the other is to basically invest in negatively correlated asset classes, so that at all points in time, the investor is hedging himself or herself against vagaries of the market. So by negatively correlated, I'm talking about asset classes which don't move in tandem in terms of the risk and return categories. So maybe add gold, maybe add international equity, maybe add some amount of commodities or currency. So that typically lends the required diversification to ensure that at any point in time, the overall portfolio is able to provide a good average return to the investor.
You mentioned that, let's talk about gold now, of course. Actually, before I ask you about asset allocation in gold, how important is it for individuals to, invest in gold beyond the consumable gold that is present in almost every household, from the poorest to the richest? Many a times people believe that, oh, okay, I already have a lot of jewelry, gold jewelry lying at home, so it's great, that there's this rally. But obviously, you're not going to go into the market and sell that off, because it's a consumable, and it has its emotions and sentiments attached to it. So, I mean, how important is it to separate that gold from, a gold bought for your investable portfolio, purely from an investment point of view?
Right. So that's a very good question, Mobina. Actually, when investors do come to us with the extent of jewelry sometimes that they hold, we don't even consider it as an asset, and add it in their financial planning goals. And the good news is, in the last quarter, I would say there has been a marked shift of investors from buying physical gold to investment options of gold, like the gold ETF and the gold bonds, the sovereign gold bond scheme, which is being offered by the government. So this is a very interesting marked trend towards using gold as an investment option rather than a traditional buy and hold in the form of a jewelry, because everybody is realizing that the costs of holding physical gold and the value of having holding physical gold is actually not as good as using investment in gold options as an investment.
Okay. Now, gold, like you suggested, Dilshad, that it should be almost 5 to 10% of your portfolio, not just because it's given great returns right now, but also, like you mentioned, that inversely related aspect of it. So, if equities go down, gold is there to support your overall portfolio. It's a great hedge, basically. Now, if you just look at it in the last 1 year, almost just about a year ago, gold was at 34,000. Today, it commands almost 54,000. So it's been almost a 60% rally in gold. So do you think now is the time to maybe, since you like you mentioned, right, you have investable gold. You've literally invested in gold so that, you can sort of enjoy the profits that it's giving out, unlike what you do with consumable gold. So do you think maybe investors should consider taking some money off gold right now, or do you think again it should stay because it's a good portfolio hedge?
So like I mentioned, gold should form part of one's portfolio, not as a trading commodity. It's always used as a asset class that you're adding. And I would ideally suggest an investment in a sovereign gold bond scheme. So there is no question of tradability or short-term buying and selling that is allowed. And investors actually earn returns both in terms of interest and the current value of gold when they get the money back after a period of 5 to 8 years. So and there is no capital gains tax as well on the sovereign gold bond scheme, so if you hold it till maturity. So I think gold should more be considered as a hedge or an asset allocation tool than more of an investment option. And considering that it's reached these highs, I would still say that hold on to gold and continue on a systematic basis. Do not add as a lump sum at these levels for sure.
So consider doing, if you could call it that, an SIP of sorts, in gold. Don't buy in lump sum, that's for sure. And any which ways, at 54,000 rupees, affordability as well could really pinch your wallet if you try to buy in lump sum. Okay, well, you know what? Let's take on board some questions and queries from our viewers then. Bal Krishna Rao Kadri writes in to us saying, my son is age 34. He's an NRI. He's been investing in mutual funds for the last 3 years via an SIP at the rate of 5,000 rupees in the funds. And he stepped up his SIPs to 7,500 in a couple of other funds. Now, there are 10 funds varied from blue chips to MNCs to small caps. There's a value discovery fund as well, an emerging business fund. Interestingly, there's another thematic fund as well thrown into the mix, and that's a consumer fund. Now, he says that he has no requirement for now to redeem the fund. He can keep it invested for another 5 years. His clear objective is wealth creation. He's interested in knowing if his portfolio is okay, because he's particularly concerned with two funds, DSP small cap and Franklin India equity, because both of these have been below par for the last couple of years. So he wants to know if he should continue with them. Further, he has already discontinued a couple of funds. The SIPs have been discontinued, that's ICICI Prudential Value, Tata India Consumer and L&T Emerging, because again he was not happy with the performance. Well, at this point of time, I'm pretty sure all of his NAVs are bleeding, so he may not be happy with any of the performance. But yeah, what is your opinion on that? The fact, Dilsha, that he has 10 funds spread across so many categories, and is it a good idea to hold a thematic fund like he is, the Tata India Consumer Fund?
Right. So as you rightly said, I think it's too wieldy a portfolio to have. Having more than 10 funds, it's the options should be based on very simple decision making based on his risk profile and chosen asset allocation. I think having allocation to too many. I think he has at least 2-3 MNC funds, which is a high allocation. That could be trimmed a bit, and he could even, the reason why small cap has actually fallen, and that has happened across both the mid cap and the small cap categories, is because obviously the markets as such have not moved up. And the first category that you will always see when the markets move up is the large cap and index based. So I would also advise if he could take in some amount of index based investment options, because they are low cost. And they ride the rally as soon as the market moves up. So it's in his interest to also consider that, and definitely trim down the portfolio a bit.
Trim down the portfolio. It'll also be easy actually to keep track that way, though mind you, I think he already is keeping a close eye on even these 10 portfolios, because he's been properly tracking each one's performance, pausing the SIPs on some where he's not happy with the performance. I think that's definitely pretty impressive. But yeah, nevertheless, even if you can, it's just better to trim down your portfolio. 10 funds is probably just a bit too much. Let's take on board our next question. It's coming in from Sai Prasad. He writes to us saying that he is investing in a couple of funds. The Franklin Focused Fund, he has a monthly SIP going on over there of about 10,000 rupees, again for the last 3 years. He said he's been investing in the fund for the last 3 years but is not happy with the performance. He wants to know if he should stop this SIP. He also has the ICICI Blue Chip Fund, wherein he's got a 5 grand SIP going on again for the last 3 years. And over there he marks that the amount of interest, okay, I'm not sure if he means interest or dividend. He may have opted for the dividend option in this fund, and hence he's saying that the amount that he's getting is less than even a fixed deposit. So he wants to know if he must switch over to another blue chip fund. Axis Mid Cap Fund, another SIP of 5,000, and Axis Small Cap Fund, again SIP of 5,000 rupees. These two funds, by the way, had done very well last year. He's been investing in them for the last 8 months. So just these 4 funds, again, like we were discussing right at the beginning, Dilsha, that if anybody's invested in mutual funds in the last 3-4 years, they really have a reason to be disappointed. Coincidentally, both of our viewers who've written to us have started investing just in the midst of the last 3 months. So what would be your advice to Sai Prasad?
Right. So I think the last 2 funds that you mentioned, the mid cap and the small cap, they're pretty fine. And as long as his time horizon is more than 7 years, these 2 funds are fine. On the focused, Franklin Focused, he could look at an alternative to that investment. And now this is actually should be in a more, informed decision that he should be taking in terms of first finding out what is his risk profile, what is his asset allocation, what exactly is he making this investment for. Basis that, the kind of selection and the categorization of the investments should be done. And like I mentioned in the beginning, adding more asset classes to one's portfolio and not just sticking to mutual funds actually would help in times like this when, like you rightly mentioned, mutual funds are not moving in the same way that many investors would have hoped in the last 2 to 3 years.
Okay, very important. Yes, you have your mutual funds, but it's also important to have other asset classes. A case in point being gold, right? Imagine if you did invest in gold as well when you started off with your mutual fund investment, which was roughly maybe 8 months ago or 3 years ago. Your portfolio would have still been doing better on an overall basis. So, like I said, gold is a great diversifier and portfolio hedge. Okay, well, Dilshad, thank you so much for joining us today on this episode of The Money Show, talking to our viewers about this market rally, or rather rebound, that we have witnessed, and, guiding our viewers as well with their questions and queries. We'll do one thing, we'll slip into a very short break right here on the show. Don't go anywhere.